The United States debt is collapsing, and dozens of media outlets and analysts warn about the consequences this will have for the country's economy, the banking crisis, the stock market, and the so elusive recession. Today, I will explain to you about Treasury bonds and how this financial instrument, often reserved for more technical discussions, moves the strings of the economy, the stock market, and even influences your daily consumption without you realizing it. The United States spends much more money than it collects through taxes and finances this fiscal deficit through instruments known as Treasury bonds. Treasury bonds, like any bond, give the right to the purchaser to receive their money back along with interest. These bonds are bought by investment funds, individual investors, foreign governments, and the Federal Reserve. Thanks to the relative economic stability of the United States and the fact that they are denominated in their own currency, these bonds have high domestic and international demand, allowing them to pay very low interest rates compared to the debt of other countries, thus financing their deficit with low interest. These bonds are traded in the markets, and although the interest they pay remains fixed from the time of issuance, which is why they are called fixed income instruments, their price varies, and therefore, the yield they offer also varies. It is precisely the increase in the yield of these bonds that has generated a lot of headlines and concern, because this increase is due to the collapse of Treasury bond prices. If these prices drop, the yield will prices rise, the yield will be lower. Based on this, you can see in this chart of 10-year Treasury bond yields how quickly they are falling in price. In fact, these yields have recently reached their highest level in the last 16 years. To understand why this is causing alarm among analysts, it's important to first understand why it's happening. Firstly, there is a change in expectations that is beginning to be reflected in bond prices. While it was previously expected that interest rates would be lowered later this year, the market is now digesting the possibility of higher interest rates for a longer period. As a result, the valuation that investors place on current bonds is lower because it is done with a higher interest rate. Secondly, one of the largest buyers of Treasury bonds, the Federal Reserve, has been reducing its portfolio since 2021. While it used to buy bonds to inject liquidity into the market, in other words, printing money, it has now stopped buying bonds and has withdrawn that money from circulation when it receives the principal payment for them. This has had a significant impact on the demand for these bonds. Thirdly, China, which has long been one of the primary purchasers of U.S. Treasury bonds, has started to reduce its purchases. In part, this is because China used to invest its trade surpluses with the United States in Treasury bonds, and now that trade between the two countries has decreased, it is buying fewer bonds. Additionally, China is seeking to reduce the dominance of the dollar. And what are the implications of all this? First, the costs of long-term loans are increasing for everyone. The rates paid by 10 and 30-year Treasury bonds serve as a benchmark for the entire economy because they are considered risk-free. This means that a loan to a company or individual, which does carry risk, must offer a higher interest rate to compensate for that risk. It makes no sense for anyone to lend at 5% to someone who might not repay, when they can lend at 5% with no risk of default. This has been particularly reflected in mortgage costs, which have increased and are at their highest in the last 23 years, making it extremely difficult for someone to buy their own home. It has also been reflected in the cost of consumer and business debt. As you can imagine, it's also a headache for the government because with its debt, which has reached a maximum of $33 trillion, it will now have to pay an increasingly higher interest rate. While it currently pays an average of 2.9% on its debt, interest costs could rise to 5% or 6% if current conditions persist. In other words, the government's interest costs could double in the coming years. This will obviously reduce the government's funds for spending and investment. And if individuals, businesses, and the government spend and invest less, it's clear the negative impact this will have on economic activity. It will also have a direct effect on the stock market. But before I tell you what it is, I'd like to invite you to subscribe to support the channel and stay updated on our new content. The stock market operates as a balance between the equity and bond markets. High yields make bonds more attractive to investors than stocks, while low yields make stocks more attractive than bonds. During the past few decades, bond yields were excessively low, which didn't generate much interest from individuals. However, everything has changed, and now the opportunity cost is much higher. Investors can earn 4.9% with a 10-year Treasury bond with a fixed return, or take the risk with an investment that could lead to losses. This increase in interest rates also diminishes the valuation of many assets because now the cash flows they generate are discounted at higher rates. This is particularly detrimental to companies that do not yet generate cash flow and are only expected to do so many years in the future because they have very little value in the current scenario. Another concern related to the collapse of U.S. debt and the rise in Treasury bond yields is related to the banking crisis that occurred earlier this year. Banks have a significant portion of their portfolios invested in these bonds, leading to unrealized losses amounting to billions of dollars. This makes the banking system particularly vulnerable if there are bank runs or reserve losses that force them to sell their bonds, realize these losses, and in turn generate more concern among their customers, as was the case a few months ago with Silvergate Bank, Silicon Valley Bank, Signature Bank, and First Republic Bank. If people do not withdraw their money from their accounts, there is no problem, but in the event of a crisis and if people do withdraw, it could become a significant amplifier. Another important consideration is that although there are changing expectations regarding what will happen to interest rates in the bond market, the stock market still seems to be pricing in a short-term decline in interest rates. However, increasing inflation and a strong job market suggest otherwise, and higher rates for a longer period could become the norm, potentially leading to significant market declines once this disparity is corrected. What do you think? Do you believe those sounding the alarm about the increase in Treasury bond yields are correct, or do you think the U.S. economy will adapt to this new interest rate environment? I would like to hear your opinion. And if you want to understand why interest rates near zero with low inflation, as seen in recent years, are virtually impossible to return to, I recommend watching this video next.